Hi, and welcome to our weekly market update from Morton Brown Family Wealth for the week of April 26th, 2021. I'm Dennis Morton here with Cody Demmel. Cody, how are you?
Good, how are you?
Good. So tonight we have a joint session of Congress where President Biden is going to be presenting a proposal that's going to affect a lot of how we plan and invest. There's been a lot of headlines the last couple of days about what's going to be in this presentation, although we still don't have all the details. We'll be waiting with bated breath to hear more tonight. But we're going to talk a little bit about today how to think about taxes as it relates to investing and planning. We're also going to talk a little bit about shortages, what's happening in the housing market, and how the last crisis is creating the next crisis, and how we should think about that as investors. Cody, why don't we start with just the housing industry, the lumber shortage. You found a great article that just talks about some of the details that are going into sky-high prices in commodities like lumber.
Yeah, so I'm not sure if anyone's been to Home Depot recently or been trying to do any home projects, but an 8-foot 2x4 is now over $7.50 when last year it was around $2.50, maybe a little less than $3. So up almost 300% just from last year at the same time.
And that's affecting all new home building. And we're talking about, existing home sales have now eclipsed new home sales, and all of these shortages are really bleeding into it. But you brought up an interesting stat about where new home starts are. So you would think people talk about, is this another housing boom? Is this another? Yeah. Where are we relative to, say, 2008, the last boom?
Yeah, we're still around 30% lower than new housing starts that we saw in 2008, 2009. So there was almost 2.4 million new houses built in 08, 09. We're still around 1.7 million in new housing starts. So still well below the levels we saw back then.
So it's not like it's peak demand or records. It's just a shortage. So Ben Carlson, in an article titled "The Psychology of Fighting the Last Crash," kind of breaks this out a little bit, because he talks about, think back to the great financial crisis, and coming out of that, when we started to see tech stocks rallying and people were really worried, oh no, this is another tech bubble that's building. No, it wasn't. It was actually the next 10 years of returns came from tech. So anybody who stayed away from that because of the burning that happened in the dot-com crisis missed out on returns. He fast forwards that to today, where you start to see housing prices going up. And if somebody says, oh my gosh, there's a housing bubble, it's going to crack, conditions are different. That's not what's happening then. It's a different situation now. So the reason why this crisis is happening is because of shortages. What happened in the lumber industry when they were burned in the housing crisis? They became very conservative. They didn't invest. They didn't build inventory. They kept a lot of cash. And suddenly, when everyone showed up at the door wanting to build a new house in 2021, they're like, we didn't have the inventory. We were expecting another crisis, and you didn't prepare for it. So there's a lot of things that are creating this, but it's important not to fight, the last crash when you're looking at a new set of circumstances. All right, now let's dive into a couple of key elements of tax changes that specifically could affect investors. We're going to talk about two of them today. One is the increase in the capital gains tax, and second is the potential removal of the step-up in basis. These are all things that we're hearing could be proposed. The details are coming together. Cody, talk a little bit about what happens on the capital gains tax and why that matters for investors.
Right now, the talks is potentially raising the long-term cap gains to 40% on the high end. And just an overview. So a capital gain happens when, if you say in a taxable account, you buy a security for $100,000 and you sell it, just to make it easy, for $200,000, you have a long-term cap gain of $100,000. So right now on the long haul, on the top end, it's 20%. So you would have a tax bill of $20,000. So if they raise that to 40, we're looking at obviously a doubling in the tax bill.
A lot of this is in your control. If you're a long-term investor, you're not actively churning and trading. I mean, day traders must be really panicked about this, because if you're participating in the markets for the long term, you can determine a little bit about when this tax is actually applied. For business owners, it's especially a big consideration, because the proposal so far sounds like it's only going to apply above $1 million. So if you're selling small amounts, not too bad. But if you're selling a business, and suddenly this capital gains tax applies, that could create an extraordinary tax bill compared to what you have right now. This could start a lot of activity happening. So if you are a smaller scale investor and realizing $50,000, $100,000 in realized gains, it looks like you're not in the crosshairs for this particular policy. But what it does, anytime we start thinking about capital gains applications, ordinary income, we have to remember that things are taxed differently. Your IRA, your 401k, anything you take out of that was already being treated as ordinary income. Your traditional IRA, your traditional 401k, any distributions. So you can still manage capital gains a little bit easier than you can from your qualified accounts. It's going to change how we think about what assets we put in which account and what our distribution strategy is going to be in taking money out, right?
Yeah, no, this is going to make it even more important to make sure that you have an advisor and to make sure that your advisor has eyes on everything. So they're doing the planning work to make sure that you're taking the assets from the right account and you have the right accounts positioned correctly, not only obviously for growth, but also now to make sure that the tax advice is in point too.
Yeah, I think, and this, we're going to parlay this into the step up in basis conversation because, I think some of the rules of thumb for which accounts to draw on might change. So that there's going to be, as each individual family's tax situation changes, it may make more sense to flip-flop which account you draw your retirement income from. But that's going to be something you have to work through with your advisor, your accountant, and figure out your situation. So another notion that this just broke yesterday, the idea that the removal of the step up in basis. Cody, what is step up in basis? What's the concept and what are the implications here?
So the concept, just high level, again, we'll go back. Someone's parents bought a security for $100,000. They passed away when the security was worth $200,000. Instead of paying taxes on that $100,000 gain, you would get a step up in basis. So whoever inherited that $200,000 wouldn't have to pay taxes till they sell it, and their cost basis jumped from 100 all the way up to 200,000.
Right. So if that's removed, then suddenly that the person inheriting owes a pretty substantial tax bill that's happening. So last year we talked about the elimination of the stretch IRA, where your heirs have to take distributions there a lot sooner, creating complicated tax situation potentially. Now we have another thing where heirs are going to be inheriting less than they might have expected. This could really change how families think about shifting assets during their lifetime. It's going to have them thinking, maybe I want my kids, I'm going to gift this to my children or move things around to watch them enjoy it because the benefit of them inheriting it is gone now because you don't then get the step up, right?
Yeah, I think that's going to be really interesting as we get closer to seeing if this is going to pass and what exactly all the details are, how the potential change in wealth over time could happen. Like you said, if someone older knows that they're not going to get that step up in basis now and they don't need those assets, why not give it to their kids or someone else that they want to use it now? So it'll be interesting to see how that affects things.
Right. And one thing we always want to emphasize here, one of my favorite accountants always says, don't let the tax tail wag the investment dog. These proposals are out there. The idea that this could happen has been out there for a while. The market is still chugging along. And it will continue to chug along until some catalyst that we probably can't predict, puts it on its heels for a little bit and then it comes back. But if you're concerned about capital gains knocking the market off of its high horse right now, or if you're worried about other tax situations being the catalyst for something that impacts your long-term investment horizon, I think it's time to step back and just pause, because the risk is that you become too conservative, and that's a real challenge right now. So if you get too conservative and take risk off of the table, then you're not earning the money that you would eventually pay gains on. We need those gains to happen. The net number might change, but we still need the gains. And it's still a challenging environment to be too conservative because of how low interest rates are. So this is a time where you have to, maybe you need a sounding board to talk this through, but I don't want to sound alarm bells over tax policy. It's going to change the way we plan, but we don't want to let the tax tail wag the investment dog. So, Cody, one other thing, which investments are going to tend to get a little bit more favored here? Different investments have different tax efficiency. What are you hearing there?
Yeah, so there's been a lot of research going into the obviously tax advantages of ETFs compared to some of the mutual funds. So right now we've seen a large inflow into ETFs, especially equity ETFs year to date, and a large outflow of equity mutual funds year to date. Equity mutual funds outflows was around 120 billion, but the equity ETF inflows was around 250 billion year to date. The reason for that is when you're selling an ETF, you're selling it to someone else on the open market. So the company running the ETF doesn't have to sell the securities inside the fund. So they're not having a sale of the securities to create a capital gain, where if you sell a mutual fund, you're selling it back to the company. So they potentially could have to sell some of the shares that they're holding inside of the mutual fund. That's why sometimes you see a capital gain distribution from the mutual funds.
Yeah. So other mutual funds, other people's redemptions can create taxable events for you. ETFs, it's just your actions, and you can manage that a little bit better. So I think there's a chance to be really intelligent about what you own, where you own it, and how you take distributions. So what I would say that this is time to engage with your professional team. Estate planning is going to be a huge push this year. So estate planning attorneys are getting ready, accountants are getting ready, financial planners are getting ready. So if you have an advisor, now is the time to check in. We're scheduling check-ins with everybody just to make sure that we know all the things that are on their plate. If that advisor does not have your full balance sheet, including non-investment or portfolio assets, real estate, businesses, all those things, now would be the time to make sure they're informed of that. And if you don't have an advisor, get one, because this is going to be a fast-moving environment, and this is what your advisor should be paid to do, not just picking stocks. It's all of this planning and integration with your team. So we're looking forward to that opportunity with our clients this year. This is it's a good time to be thinking critically about the future and planning. So we appreciate that. All right, Cody, we're going to be coming up on, you just had the Academy Awards this week, and really light attendance. It was the ratings were pretty poor this year. You and I were talking movies a couple of weeks ago, and in my household, my son's a really big Star Wars fan, and he's been watching that constantly since he was young, all the different iterations. You mentioned something to me last week that really caught me off guard. How many times have you seen Star Wars?
0. It's kind of embarrassing to admit. I have never seen a Star Wars movie. I've probably seen like 5-10 minutes. They're always on TV. Flip it through, but I've probably never even seen a fifth of a Star Wars movie.
Wow. Okay. So the first Morton Brown movie night, once we're allowed to get together in the same place, will be, I think, 13 movies and a couple of television. So get that done. But excellent. I've never seen Top Gun. I think that was, for when I grew up, that should have been on the, Goose and Maverick should have been on the agenda at some point. They just never were. So, all right. Well, listen, we appreciate all of your questions. Thanks. If you participated in our market update last week, we appreciate it. If there's a topic that you'd like for us to cover, let us know. We look forward to catching up with you again next week. Take care.